Hello everyone, you are with me again, Lufi Yuwana Mursita, at the online course of Advanced Accounting at the Accounting Department Sekolah Tinggi Ilmu Ekonomi Perbanas Surabaya. And today we would like to talk about the joint ventures. Joint ventures in Bahasa is called as Ventura Bersama, and the Ventura Bersama has a specific characteristic that likely similar with the partnership, but there is a special feature of the joint venture itself. What is that? We would like to talk after this. So the joint venture's objective was to combine management participants and capital contributor in undertaking limited to the completion of specific trading projects. So the terms that should be specific or special in here is the specific trading. That is the special feature of the joint ventures rather than the partnership. Joint ventures take many different forms, like the partnership and corporate, domestic and foreign, and temporary, as well as the relatively permanent. So it means that the joint ventures actually refer to the objective of it health itself, and rather about the form of the joint ventures itself can be vary. For example, is just like I have mentioned here. So about the time itself, it is also can be a temporary. For example, if the objective already achieved, then the joint ventures can be ended. Meanwhile, there are the other types of the joint ventures that can be permanent too. So the joint ventures is a business entity that is owned, operated, and jointly controlled by a small group of investors, or especially it is called as ventures. So ventures is the parties that is conducting the joint venture. For the conduct of a specific business undertaking that provides mutual benefits for each of the ventures. So here I would like to highlight that the specific terms for the joint ventures is the specific business or the specific purpose of the joint venture itself. Based on the standard of accounting, whether it is in the international and national level, joint venture is defined as a joint arrangement whereby the parties that have joint control of the arrangement have rights to the net assets of the arrangement. So here, between the parties that is called as venturers, their operations is related with the share rights related with the net assets of the arrangement itself. So actually, there is the other type of arrangement that is the specific characteristic is using a joint program, and that other type of the arrangement is called as joint operations. But there are several differences between the joint venture and the joint operations that we also would like to discuss later. This is the examples of the disclosure in the annual report that is inform us about the joint ventures. So this is the example of joint ventures disclosure in PT Astra International TBK 2019. And here we have the information about the Astra. It is the company in here. And Gojek announced an agreement establishing a joint venture to encourage the development of the four-wheel ride-hailing business, which is expected to increase the availability of door-to-door online transportation services on the community. Astra also announced an investment of 100 million USD in the first closing of the Gojek series of fundraising. With the additional investment, Astra's total investment in Gojek achieved 250 million USD. So here, that's like I have mentioned before, there is a specific characteristic for the joint ventures conduction. It is about the specific purpose. And from this disclosure, we can take the specific purpose of the joint ventures is in this line. It is to encourage the development of the four-wheel ride-hailing business. So whether the joint ventures would be held in the longer time or in the shorter time, it is based on whether this purpose can be achieved at a short or in the long time. So that is also based on the agreement or depends on the agreement for these joint ventures conductions. Now we go to the organizational structure of joint ventures. The first one is the corporate joint venture. A corporate joint venture is a corporation owned by, operated by a small group of venturers to accomplish a mutually beneficial venture or project. The other type of joint venture is the general partnership. It is an association in which each partner has unlimited liability, just like we have discussed for several weeks before about the partnership. So it is actually the type of the joint venture itself, but there is a specific characteristic that maybe the partnership is rather more general rather than the joint ventures itself. And also about the liability is unlimited for the partnership, but for the joint venture is not always like that. The other part, the other types of the joint venture is the limited partnership. It is an association in which one or more general partners have unlimited liability and one or more partners have a limited liability. So it is a specific types of the partnership itself. There are the terms of limited partnerships, which refer to that a partial of the liability conduction of the partnership itself can be limited, but the other partial is to be unlimited. And the next type of the joint ventures is the undivided interest. It is an ownership arrangement in which two or more parties jointly own property and title is held individually to the extent of each party's interest. So this four is the type of the joint ventures based on the books of Bims et al. At the 11th edition, but I checked in the 13th edition, these four terms is also presented. And then, just like I have mentioned before, we would like to also talk about the differences between the joint ventures and the joint operations. Both of them are actually the type of the joint arrangement. It is the type of the business or the arrangement that is conducted by more than one party. It means that there are two parties or more that are conducting a business or the operations together, but the general term is the joint arrangements, but there are two types. The first one is the joint ventures itself, and the other one is the joint operations. And this is the general pictures of the differences to make a difference between the joint operations and the joint venture. And I would like to zoom this from the first part. This is the bigger picture of this part. So first, we talk about the structure. If we talk about the structure, there is a question: is the joint arrangement structured through a vehicle that is parted from the parties? So the term of the vehicle is here. It doesn't mean the vehicle literally, but the vehicle means the operations. So whether the operation is to be in the, it is separated from the parties itself or not. But here, if the answer is no, so it is called as the joint operations. But if the answer is yes, so it could be possibly to be the joint ventures, but there would be another consideration to go to the joint ventures as the final characteristic or final terms for these operations. And then the next question is, does the legal form of the joint arrangement give parties rights to specific assets and obligation for specific liabilities of the arrangement, as opposed to share of the net assets? It is about the legal form aspects. So just like I have mentioned before, the term of the joint ventures is especially the rights to conduct about only the assets together. So not more than the assets, just like the joint operation. So if we have the condition that the operation is also related jointly about the obligation, not only about the assets, so it is go to the joint operations. But if it is only about the assets, so it would be the joint operations. Now let's go to the next part, bigger size picture. So after we answer about the conduction of the rights to the assets together, then it is about the contractual agreement. The question is, does the contractual agreement of the joint arrangement give parties rights to assets and obligations for liabilities of the joint arrangement? If the answer is yes, then it goes to the joint operations. Meanwhile, if the answer is no, so it is going to the next considerations about the joint venture. Then the last consideration is at the aspect of other facts and circumstances. For example, the question is like, are there other facts and circumstances such as, do the parties have rights to substantially all the economic benefits of the assets in the vehicle, and does it depend on the parties on a continuous basis to settle all liabilities? If the answer is yes, and we can conclude it is the joint operations. Meanwhile, if the answer is no, then it would be absolutely in the joint ventures. So I hope that start from the discussion, starting from the top up to the bottom of this picture, we can conclude that the joint venture has a several characteristic and consideration to be go to the term of joint venture itself. Now it is the main topic today about the accounting for the corporate joint ventures. So this accounting is based on several international and national standards. The international accounting standards for the joint ventures consist of at least 3, but there are more actually. For the list 3 is actually, the first one is the IFRS 11. It is about the joint arrangements that, just like I have mentioned before, the general term for the joint business is the joint arrangements. And the second is the IFRS 12 about the disclosure of interest in other entities. And third one is the IAS 28 about the investment in associates and joint ventures. Meanwhile, for the national accounting standards, national here means the Indonesia. There are 2 at least. The first one is the PSAK 66 about pengaturan bersama, and PSAK 15 about the investasi pada entitas asosiasi dan ventura bersama. And actually, both of them has adopted the IFRS as the international standard. So based on IFRS 11 and also the PSAK 66, investment in the common stock of joint ventures or other investment accounted for by the equity method, but especially it is for the consolidated or individual financial statement or laporan tak terpisah. And how to calculate the equity method actually? So the difference between the equity method with the other method, just like the cost method, is the investment in joint venture is calculated by the initial cost plus with the post-acquisition change in the joint venture share of net assets. So it means that the initial cost is the amount of cash that is paid for conduction of the joint venture. For example, if we go back to the example in the PT Astra, then the amount that to be invested is actually has been the total for the initial cost plus with the next change related with the joint venture share of the net assets. Now, before going to the practical part, then related with the accounting for the corporate joint ventures, actually there are two ways to make the entry. The first one, just like I have mentioned before, it is the consolidated or the individual financial statements, usually called as the equity method. So it is actually what is the method mentioned in the both international and national standard. But if there is a specific cases, it is can use the spirit of financial statements that is usually at cost for the entry, less any subsequent impairment for the cost itself. So this exception applying for the equity method because the joint venture holds its interest in a joint venture directly or indirectly through a venture capital organization. So for example is a unit trust, mutual fund, or certain similar entities that it means there are the third party that help the conduction for the joint ventures, not directly from one party to the other party, that is in the field, they work together for the joint ventures. So go to the example. So here we firstly discuss about the consolidated or the individual financial statements method. It is the equity method. So here there are three parties in here, the Andi, Benny, and Kopi agree to make a joint venture in a property sector. You have to know that mostly the joint venture is conducted in this sector. It is in the property sector because the property sector usually need a large amount of money to invest. So it would be better if they conduct it together with the other party. The transaction of the joint venture are as follows. The first one is Andi provide lands with a fair value of 100,000 and its purchase price is $75,000. So it means that a book value of the land itself. The second transaction is about Penny, which pay for the $60,000 additional cost on the land. So maybe there are about the biaya balik nama and other type of the cost related with the land itself. The third one is about the Kopi, which provides cash of $40,000 to Andi, and Andi here is appointed to be the managing partner, appointed to be the managing partner of the joint venture itself. And then the fourth transaction is that Andi pays for the advertisement expense or cost for this amount. And then the fifth transaction is the land is sold for $250,000. So the land is actually what they to be the purpose of the business in this property sector. So it is actually in the inventory of the business, and it is already sold. With the payment consists of $50,000 for the cash, and the remaining amount from the 2050 minus with the 50, it is the $200,000 is using the notes receivable. So not mostly using the cash. The sixth transaction is the notes receivable is sold for 10% discount. So it would be in the cash after the sale for the notes receivable. The seventh transaction is the calculation for the distribution of net income resulted from the joint venture operations. The next is the commission for Andi as the managing partner of $5,000 is being recorded. And after that, the allocation for net income is based on the ratio of 10, 6, and 4, and the total would be 20 for Andi, Benny, and Kobi respectively. But here, we have to calculate first about the net income. The net income comes from the amount getting the result of the sale for the land as the inventory of the business, minus with this amount. Where this amount come from? The $100 comes from this from the land investment from Andi. Meanwhile, for the 60 from the Benny, and the $37,500 come from the payment for the advertisement. And the next is 20, and the 20 comes from the result of the notes receivable in here. So the total of the net income would be $32,500. Andi distribute cash for the net income allocations based on these calculations at the 9th transaction. So firstly, we go to the consolidated and individual financial statements, just like I have mentioned before. So go to the first transaction, just like we have discussed. It is about the investment from Andi in the form of land to the joint venture. So if this is using the consolidated or individual financial statements, it means that all of the transaction is recorded in one. So when any transaction is occurring, then all of the partners or all of the venturers would make the record too. But there are several differences for the record, even though the transaction is the same. For example, is for this one, for the first transaction about the Andi's investment, so it is recorded as the joint venture in 3 of them. On these 3 venturers book, it would be debit in the joint venture. It means that the investment for the joint venture itself, and then the credit for the Andi would be in the land, because Andi already give the land to the joint venture, so it would be decreasing the amount of the land in the Andi's book. Meanwhile, there is a gain on land for giving to this joint venture, and this is the difference between the 100 and 75. The next one is the Benny's book. The Benny's book record debit is joint venture and the credit is Andi capital, so it increased the Andi capital record. And also the same for the Kobe's book, it is also recording the Andi capital in the credit. For the next is about the investment related with the additional cost from Benny. So for Benny first, just like before, because of this is the additional amount for the investment, there would be an increase in the joint venture accounts for 3 of the books. And then if we talk about the Benny as the investor, here the cash of the Benny would be decreasing for the amount of the cost itself. So the cash would be in the credit. Meanwhile, for the Andi's book, it would increase the Benny capital, just like when the Andi give the investment to the joint ventures, then the other ventures will record the Andi capital increase. So it is the same when Benny as the other venture give the investment to the joint ventures. So the Benny, so the Andi and also Kobe will record the same for the credit column. I hope you are not confused up to this part. The next, it is about, what is it? Sorry. So it is about the Kobe provide cash, about $40,000 to Andi as the managing partner. So the cash would be here. First, we can pay attention to the Andi's book as the receiver of the cash. So the GV cash will increase for 40. Meanwhile, for the Kobe capital will in the credit column for 40. And for the other, there would be a decrease for the Andi capital in here. And the credit would be the Kobe capital and the cash. Why Kobe in here? Because Kobe is the ventures who give the cash to Andi for the managing partner job. The next journal is about the advertisement cost record. So who pays for the advertisement is Andi. So that's why when recorded the transaction, here the GV cash will decrease for this amount of the cost, and the debit is the joint ventures investment. So all of the costs would be increased for the joint venture investment. And the debit column would be the same for Penny and Kobe. Meanwhile, for the credit column would be Andi Capital again, because who pay for this transaction is Andi, just like before. The fifth transaction is about the land is sold for the 250. So here, the joint venture will be decreased for 250 because this is the amount of which the land included. So if you remember the first record for the transaction, the land is already added to the amount of the joint venture. That's why when it is sold, then it would be in the credit column. Meanwhile, for the debit column would be the cash, just like the amount they receive when the transaction occurs, and the result, the remaining amount would be in the notes receivable. How about the Benny's and Kobe's book? Then the joint venture also the same in the credit column because it is decreasing. So why this is Andy? Because Andy is the managing partner and his capital is used as the first that is being decreased if there is this kind of transaction. And also the Andy is actually the biggest pool of all the transaction related with the investment itself. Go to the next part, it is the SFAS transaction, and the SFAS transaction is about the sale for the notes receivable with a discount. This one. And we make the journal entry for this method would be the JV notes receivable, just like before the previous amount is $200,000. And because there is the amount of percentage for the discount, then this would be the discount, and the amount of the cash would be the difference between the notes receivable with the discount itself. And the discount is recorded in the joint venture, and the cash is the amount of the net amount of the cash they receive. For the Benny's and Kobe's book, the debit column would be only recording about the joint venture discount related with the discount, and the credit column will increase the Andy capital. After that, we go to the seventh transaction. The seventh transaction is about the distribution of the net income calculations. So this one. So because we have calculated that the total of the net income is $500,000, then it would be allocated to each of these transactions. How to calculate the allocation is just like the same with previously we have discussed about the partnership. So we use the percentage on the ratio that we have received before. So for the Andy is 10, for the Benny is 6, and for Kobe is 4. And because of all of them is assumed as the 100%, then it would be using the denominator and numerator for the calculations. For the Andy's book, it will record that the joint venture will increase for $500,000, sorry. And then the allocation for this is Andy, and this one is Penny, and this one is the, oh sorry, this is not the capital but the copy. So after that, the difference of why this is not like the partnership is because when it is in the Andy's book, so for the Andy's allocation would be using the net income from joint venture account. Meanwhile, for the other is using the same account just like the partnership. So for Penny is Penny capital, for Kobe is Kobe capital. Go to the Penny's book. There are the same amounts that we can see in here, but the difference is at the record for the allocation for Penny itself. This amount would be recorded by net income from joint ventures. Meanwhile, for Andi and also Kobe would be recorded just like its name. It is the capital for each of the ventures. And also the same for the Kobe, when it is recording the amount of allocation of income to Kobe, then it would be 5,500 for the net income from joint venture. Meanwhile, for the Andy and Benny will be recorded at the name for the account is the capital itself. Okay, then the next journal is about the distribution of the cash, and the distribution of the cash is conducted when the joint venture's purpose of or the objective already achieved. So because in this example, we can understand that the purpose or the specific objective for the joint venture is to sell for the land itself, and the sell for the land already achieved, then the joint ventures can distribute the cash they already received from the transaction. So here the total for the cash is this amount. It is calculated by making the plus minus starting from the beginning of the transaction. You can check by yourself for this amount, and after that we can make an allocation to each of the ventures by using the ratio, just like we do for the 7 transaction. So for the Andy's book, there would be a cash in here. Why this is cash? Because it is the Andy's book. So for the allocation for Andy would be increase the cash transaction. The cash itself is increasing the Andy's book, Andy's own book, not the JV cash, but this is the Andy's cash. And for the Benny and Kobe will be increased for the amount of the allocation, and the name is using the capital, just like before. For the Benny's book, the cash he received would be the amount of the allocations, and then he only record for the Kobe capital because Benny and Kobe are not the managing partner, so they doesn't need to calculate or record for the cash received in Andy's book. And for the Andy's capital is in the credit column for this amount. This is actually the total for these two, but not the same with this amount, yeah. So it is the total for these two. Meanwhile, for the Kobe, it is the same with the Benny's logic in recording. So for the cash is the amount that Kobe's received from the joint ventures, and he only record for the Benny, who is not the managing partner of the joint venture. And the total for the Andy is actually the same with the Benny's book. It is the total for the Benny and Kobe received of cash from the process of joint ventures. So up to this transaction, the 8th transaction, actually the joint ventures already achieved the purpose or the objective based on the reason they conducted. Okay, now go to the next part. It is about the other method that I have mentioned before, about the spared financial statements method. So it is used at cost method. When using this kind of transaction method, transaction record method, we use the same example just like before, but we can see the differences when we record the transaction in the journal entry. So the other name of this method, just like the name, it is the spared financial statement. So it means that each of the ventures do only for specific journal entry, but the book for the joint ventures itself is actually being sparedly from each of the book of the ventures. So it means that when we are talking about the example, it is the Gojek and Astra, then they have a spared book not included in the Astra and Gojek books for the record. Meanwhile, for the Astra and the Gojek will make a record for several transactions. Let's see for the transaction record. So here, for the first transaction related with the investment from Andi related with the land accounts. So the Andi's book will record for the investment in JV would be increasing for 100, and the credit column would be the same with the previous method and the equity method. But for the spirit book or the separately book from 3 of the venturers will also make their own record. So for the land will increase and the ND will increase too in the credit column in here, and the amount of the investment in JV. So it is 100. So it is assumed like a spirit book. So all of the transaction is recorded just like when we make a transaction on ordinary transaction journal. The next journal is for the transaction of additional cost that is paid by Benny. And here why this is land, because the amount of the additional cost is added to the land itself. It is related with the land. Just like I have explained you, for example, is biaya balik nama and other types of costs related with the land that can be capitalized to the land account. Then the credit column would be Benny because Benny has paid for this transaction. Meanwhile, for the Benny's book, it would be debit in the investment in JV, and then he decreased his cash for the amount of the transaction. Then the next is the payment for the ND as the managing partner paid by the Kobe. So here the Kobe capital will increase and the cash for the joint venture will increase too, because Andy as the managing partner assume that it will be capitalized first in the cash account for Andy. And after that, for the marketing expense, the marketing expense is assumed paid by the joint venture itself. So here, the cash for the payment in the marketing expense will decrease directly from the joint venture's account, and also the marketing expense will also increase the marketing expense in the joint venture's book, but no entry for the other book for the ventures itself. The next is about the sale of the land, and here the sale of the land debit the cash for 50. It is based on the amount that they received at the transaction date, and the other or the remaining amount is going to the notes receivable just like before. But goes to the credit column. So this amount comes from the total of the book value related with the land. So it is 100 plus with the 60. So the book value of the land is actually 160. So in the credit column, it would be the amount of the book value. This is the book value of the land according to the joint venture book. So the difference between the debit column with the 100 itself will be recorded as the gain on land sale in here. So it is different with the previous method using the equity method. And the next transaction, it is about the sale for the accounts receivable, and the credit column will decrease the accounts receivable. The debit column is the cash as the first. It is the amount of the net cash received from the transaction, and the discount is called as the interest expense for the record itself. It is the same amount with the previous calculations. The next transaction is about the record for the allocations. So here, what should be allocated is the amount of the gain itself, because this is the result from the transaction in the joint ventures, comes from the 5th transaction record, and after that we need to make the record for the marketing and the interest expense in the credit column. So it means that it decreased the amount can be allocated to the ventures. this is the net income, and then this is the expense. So the amount that can be allocated, the net amount is the 90 minus with this amount. After that, after we have received the amount, or we have the result of this calculation, then we just can make the allocation calculation by using the ratio, the 10, the 6, and the 4. And this is the record for the joint ventures book. But for the ND, Penny, and Copy, they only make the calculation and also the record for the transaction receipt of the net income itself. So for the investment in JV will increase for 3 of the ventures book, and then the credit will be increasing the net income accounts. And the amount is based on the allocation resulted in here. The last transaction record is for the cash allocation, and I think that you will be not confused because this amount has been calculated before. The result is the same. And for the Andes, Pennies, and Kobe's book, respectively, they make the debit column is cash for the record, and the credit column is investment in JV will decrease. So it means that when this transaction occurs and be recorded, the JV already ended because the investment accounts will be 0 after this record going to the ledger accounts. So that's all the materials for the joint ventures. I hope that you are not confused with the adjustment from the mindset in the partnership journal entry. Then we go to the ventures or the joint ventures. And I hope that you have any question. Let's discuss in the next meeting. So that's all for today, and this is the reference for the materials today. You can learn more from this reference if you want. So happy learning and see you.